Do you think you are smart by paying your debts on time? So let me tell you something that will turn your head inside out and probably make you mad at me for the next 10 minutes. But then you'll understand why I spent 45 years building one of the biggest hedge funds in the world by doing exactly the opposite of what you were taught. The brutal truth is that rich people don't pay debts. They manage them strategically. And there is a huge mathematical difference between these two approaches that separates those who build wealth from those who work their entire lives for banks. I saw this in 1987 when investors rushing to pay off their debts missed the biggest buying opportunities of the decade. I saw it again in 2008 when those who maintained strategic liquidity instead of eliminating debts multiplied assets by 5 while those responsible were paralyzed. And now, in 2025, I'm seeing the same pattern repeat itself with interest rates that have created the biggest cost of capital distortion in 3 decades. The difference between someone who pays off all their debts and someone who manages them strategically is literally the difference between ending their life with $300,000 or $3 million. And I'm going to prove it to you with math so simple that even a child can understand it. But here's the problem. Since you were little, you were taught that debt is bad, that a good man pays what he owes, that you should only buy what you can pay in cash. And all these beautiful and morally correct beliefs are keeping you poor, while the really rich use the exact opposite of these principles to build empires. And if you're not already subscribed to this channel, subscribe now, because what I'm going to share in the coming weeks about how the financial elite really use debt could be the difference between you dying working or retiring a decade early with triple the wealth you would have, following the conventional advice that everyone repeats but no one questions. At Bridgewater, we manage $160 billion, and I can guarantee you that none of our ultra-wealthy clients are rushing to pay off their 2.8% mortgages when they can invest that money at 8 or 10%. They understand something fundamental about how money works, that schools don't teach, and that the conventional financial industry hides from you because it's more profitable to keep you paying interest on expensive debt while convincing you that all debt is equal. There is debt that destroys you, and there is debt that builds you, and confusing the two is the most expensive mistake that the middle class makes every day. Now let me show you the 5 mathematical signs that prove you are being fooled by the narrative that paying off debt is always the right thing to do. The first sign is what I call cost of capital arbitrage. When you have a 3% mortgage and fail to invest in assets that historically return 9% per year to pay off that mortgage faster, you are losing 6% per year on every dollar you use for repayment. Over 20 years on a $300,000 mortgage, this represents a difference of $450,000 in final equity. It's not theory, it's what happens mathematically. The second sign is the erosion of purchasing power via inflation. You are paying off debt with dollars that are worth less and less. If you owe $100,000 today and inflation averages 3% a year, 10 years from now, you will be paying with dollars that are worth 26% less. It's as if your real debt shrinks on its own while your investments grow. Anyone who rushes to pay loses this automatic benefit. The third sign is what I call the invisible opportunity cost. During 2008 and 2009, when everything was in liquidation, those who had maintained cheap debt and kept capital available bought shares at 10 or 12 times earnings that today are worth 5 times as much. Those who had spent all the extra money paying their mortgage were left watching the opportunity of the century pass by. I studied 23 major crises in different countries, and in all of them, without exception, those who maintained strategic liquidity and cheap debt outperformed those who had zero debt. The fourth sign is the tax deduction leverage you waste. In the United States, mortgage interest is deductible, which means that every dollar of interest saves you about 22 to 37 cents in taxes, depending on your bracket. When you pay off your mortgage, you lose this deduction. For someone paying $10,000 in interest a year, that's $3,700 of tax savings wasted. The fifth sign, and perhaps the most devastating, is what I call the speed of wealth building. When you use all your extra money to pay off debt, your net worth increases linearly. When you keep debt cheap and invest capital, your wealth grows exponentially through compound interest. The difference at 45 is the difference between having $500,000 or $2.5 million in liquid assets. All 5 of these signs are working against you right now if you're following conventional advice to pay off debt as quickly as possible. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because this pay-for-everything mentality is spread globally. And I want to understand how many people in different places are trapped in this trap that the financial industry perpetuates because it is incredibly profitable for banks to see you as an obedient payer rather than a strategic allocator of capital. Let me tell you 2 stories that perfectly illustrate the brutal cost of this pay-for-everything mentality. The first is about an executive I met in 2005. Let's call him James. He made $120,000 a year, had a mortgage of $250,000 at 5.2%, and was obsessed with getting rid of it. Every bonus, every extra penny, everything went toward repayment. His friends thought he was super responsible. His wife loved watching the mortgage balance go down. In 2007, he finally paid off his debt. He was free. His house was paid off at the age of 42. But here's the problem. In September of 2088, when the market crashed, James didn't have a net penny to invest. He had all his assets tied up in a house that was now worth 35% less. Meanwhile, a colleague of his, David, had kept his mortgage to a minimum and invested any extra money in a diversified portfolio. When the crisis hit, David had $180,000 in cash and liquid investments. Yes, the value had dropped to $110,000, but it had liquidity. He bought S&P stock 500 to 650 points, bought commercial properties that were being liquidated. He bought corporate bonds from solid companies paying 14% a year because everyone was panicking. By 2015, 7 years later, James's house had returned to its original value of $350,000. He had $350,000 in assets. David? Their investments made during the crisis had multiplied by 4.2. He had $460,000 in investments, plus the house that still had a mortgage of $210,000, but was worth $340,000. Net worth of $590,000 to James's $350,000. The difference? $240,000 in 7 years. And it happened because David understood something James never did. Cheap debt on an asset that appreciates while you hold capital for opportunities is a tool, not a burden. The second story is even more dramatic. In 1996, I met a businessman in San Diego who had a solid business generating $200,000 in free profit per year. He had a philosophy: 0 debts, not a penny, everything in sight. When he needed to expand, he raised the money first. When I wanted to buy equipment, I paid cash. Everyone admired his discipline. At the same time, another entrepreneur in the same industry had a different approach. He maintained a $500,000 line of credit that he renewed annually at 6%. I never used everything, but I kept it available. When opportunities arose, acquiring a smaller competitor, purchasing equipment at a cash discount, he took out the credit, executed it, and paid over 24 months, while the return was already coming in. From 1996 to 2015, the debt-free businessman grew his business linearly, from $200,000 to $580,000 annual profit in 19 years. Solid, but slow. The other? His business went from $200,000 to $2.3 million annual profit in the same period. The difference? He made 11 strategic acquisitions along the way, all partially financed with that line of credit he kept available. Each acquisition was paid for in 18 to 30 months through the acquired business's own cash flow, and then the asset would generate forever. The first entrepreneur had built a business that was worth perhaps $2 million in valuation. The second sold for $28 million in 2017. Both were disciplined, hardworking, competent. The $26 million difference came from a single philosophical decision about how to view debt. One saw her as an enemy to be eliminated, another saw it as a tool to be managed. Now let me introduce you to the framework that allows you to use D as a construction tool rather than a weight on your back. I call this strategic liability management, and it's the exact opposite of what you learned at home. The logic is simple, but requires you to separate emotion from mathematics. First principle: all debt has a cost of capital. If your mortgage costs 3.5% a year, that's your cost of capital for that money. Second principle: every investment has an expected return. Stocks historically return 9.8% per year. Well-purchased commercial properties return 8 to 12%. Solid deals return 15 to 30%. Third principle: whenever the expected return exceeds the cost of capital by a safe margin, managing debt instead of eliminating it accelerates wealth building. This is not opinion. It is simple compound mathematics. At Bridgewater, we use this framework on an institutional scale. When we managed $140 billion in 2008, we did not liquidate positions to pay off lines of credit that cost 3% when the positions offered an expected return of 8 to 10%. We did the opposite. We kept the debt cheap, rolled to longer maturities when possible, and used the capital to buy liquidation assets that returned 17% per year for the next 5 years. Our clients didn't get rich paying off debt. They got rich by strategically managing debt while allocating capital to higher return opportunities. Here's how this applies to you. If you have a 3% mortgage and an extra $1,000 a month, you have two options. Option A: pay off the mortgage. You save 3% a year on that money, but you lose liquidity and the tax deduction. Over the course of 20 years, by paying off $240,000, you save approximately $62,000 in interest. It sounds great until you see option B: investing the $1,000 a month in a low-cost index portfolio that historically returns 9.8% per year. Over 20 years, you would have accumulated approximately $730,000. Subtract the $240,000 you invested, and you generated $490,000 in earnings. Even taking out capital gains taxes of 20%, you have $392,000 in net gain. Compare that to the $62,000 saved by paying off the mortgage. Difference of $330,000. $330,000 is the cost of following the conventional advice of being a good payer. And that assumes you didn't catch any exceptional opportunities along the way, which is unrealistic. With available liquidity, you would probably have bought during the 2020 crisis, or taken advantage of a specific opportunity in your area, multiplying this result even further. The framework is not about being irresponsible. It is about being mathematically correct. The first critical protective action you need to implement now is to create what I call a debt ladder. You'll categorize every penny you owe into one of 4 categories based on cost and functionality. Category 1: destructive debt. Anything above 8% per year that does not finance productive assets. Credit card at 18%. Special check at 140%. Personal loan at 12%. This debt mathematically destroys you and needs to be eliminated with absolute ferocity. There is no arbitrage possible when you pay 18%. The market is not going to give you 25% consistently to compensate. You attack this debt with everything you have. Cut expenses, sell what you don't use, do weekend work. It doesn't matter. Every extra penny goes toward eliminating this in order from highest to lowest interest. There is no discussion. There is no alternative strategy. Credit cards are financial poison, and you need to get them out of your life urgently. Category 2: neutral debt. Interest between 5 and 8% financing assets that do not appreciate in value. Car financing at 6%. Payroll loan at 7%. This debt doesn't destroy you, but it doesn't help you either. You pay it in a disciplined manner, but do not accelerate payment. Keep the minimum programmed. Don't put extra money there. Why? Because between 5 and 8%, you can break even or earn a little by investing. So it doesn't make sense to shift capital to gain a minimum margin when you can be building a reserve of opportunity. Category 3. Constructive debt. Interest below 5% financing assets that appreciate in value or generate income. Mortgage at 3.5%. Commercial property financing at 4%. Business line of credit at 4.8%. This is debt you manage strategically. Never eliminate early. You pay the religiously required minimum. Maintains perfect credit so you can refinance if rates drop, but doesn't put a dime into voluntary repayment. Every dollar you would put toward paying off that debt goes into Category 4. Category 4. Opportunity capital. That's not debt. It's money you didn't use to pay off cheap debt. This capital is invested in liquid assets that generate a return greater than the cost of its constructive debt. Part in S&P 500 index fund for long-term growth, part in REITs for diversification and dividends, part in cash or cash equivalents for tactical opportunities. The mathematical rule is brutal in its simplicity. As long as the average return on your opportunity capital exceeds the average cost of your constructive debt by at least a 3 percentage point margin of safety, you are building equity faster than if you had paid off the debt. In 20 years, the difference is hundreds of thousands of dollars. The mistake that destroys this is mixing the categories. Someone has a credit card at 18% but is paying the mortgage in advance because the mortgage is bigger and seems more important. Mathematically, it is suicide. The hierarchy is absolute. Eliminate destructive. Keep neutral at a minimum. Manage constructive strategically. Maximize opportunity capital. And here's the mistake I see all the time. People are afraid of constructive debt because they confuse it with destructive debt. They classify everything as bad. 18% card debt and 3% mortgage debt are treated with the same urgency of elimination. It's like a doctor treating ingrown toenails and cancer with the same priority. One bothers you, another kills you. Destructive debt kills you. Constructive debt builds you. The second critical action is what I call the monthly arbitrage test. On the first day of every month, you will sit down and do a simple math. Takes the weighted average interest rate of all your constructive debt. If you have a $300,000 3% mortgage and a $50,000 5% business line of credit, your weighted average rate is 3.28%. This is your cost of capital. Now, take the return of the last 12 months of your opportunity capital. If you have $100,000 invested and they generated $9,200 in the last 12 months, your return was 9.2%. Subtract your cost of capital from your return. 9.2 minus 3.2, 8 equals 5.92% positive spread. This means that every dollar held in constructive debt while you maintain invested capital generated you 5.92% net gain. In $100,000, that's $5,920 of wealth created by the management strategy rather than payment. Now, if in a month you do this calculation and the spread becomes negative, then you have a problem that needs to be corrected. Either your debt has become too expensive and you need to refinance, or your investments are performing too poorly and you need to reallocate, or the market is at a stage where it makes sense to reduce debt temporarily. But the point is that you are making decisions based on monthly data, not emotion or generic advice. At Bridgewater, we did this every day on an institutional scale. We knew in real time whether our leverage was creating or destroying value. When the spread turned against us, we rebalanced. When it increased, we leveraged more. For you, monthly is enough, but you need to do it religiously. Without this test, you are flying blind. You may be paying debt you should maintain, or maintaining debt you should pay. The test gives you mathematical objectivity. And here's the insight that takes years to assimilate. This positive spread isn't luck or timing. It's the structural risk premium that the market pays. Historically, stocks return about 6% above long-term government bonds. Long-term government bonds yield about 2 to 3% above inflation. Your mortgage costs approximately the bond rate plus a 1 to 2% margin for the bank. So structurally, investing in shares while holding a mortgage gives you the full equity risk premium. There are 230 years of market data showing that this works. It is not a modern theory, it is the basis of how heritage has been built for centuries. But no one teaches you this because it's easier to sell the moral narrative that debt is bad. Banks earn more when you pay quickly because you come back faster to pick up another debt. They don't want you doing the math on how much richer you would be by keeping the debt cheap and investing the difference. The third action is to build what I call a liquidity firewall, and this is absolutely non-negotiable. Before you keep a penny in constructive debt beyond what you already have, you need to have at least 6 months of essential expenses in cash or equivalents, not in stocks, not in real estate, not in Bitcoin. In cash, or something that you can withdraw in 24 hours without losing principal. Why? Because the difference between debt as a tool and debt as a trap is liquidity. When you have the firewall, any unexpected event, job loss, medical emergency, major repair, does not force you to sell investments at the worst time or go into default. You absorb the shock, continue paying your obligations, maintain perfect credit, and look for work or solve the problem without despair. Without the firewall, the first crisis destroys you. You start falling behind on payments, your credit plummets, you lose access to refinancing, you are forced to liquidate investments when they are down. I saw this happen in 2008 with thousands of people. They had followed half the advice to use debt to leverage investments, but they hadn't built the firewall. When they lost a job or had an emergency, they couldn't pay their mortgage. The bank foreclosed, they lost their house and their investments. It was devastating and preventable. At Bridgewater, we have always maintained liquidity reserves commensurate with our leverage. The more leveraged we were, the more strategic liquidity we maintained. The rule was simple. You need to be able to survive 18 months of negative cash flow without being forced to liquidate positions. For you, 6 months of essential expenses is the absolute minimum. 12 months is better. 18 months is ideal. And here's the mistake I see. People invest every extra penny, hold cheap debt, but don't have the firewall. Then the first turbulence destroys the entire strategy. They sell their investments in a panic, pay off their debt in a hurry, and are left with zero assets and financial trauma. The firewall gives you time. Time to wait for the market to recover, time to find new work at your salary level, time to solve problems without panic. And the firewall math is favorable too. Yes, you leave 6 months of expenses in the account yielding 2% instead of investing at 8 or 9. You lose 6 or 7 points of return on that money, but the cost of insurance is infinitely lower than the cost of the disaster it prevents. Having $25,000 in cash yielding 2% instead of 8% costs you $1,500 a year in lost returns. Not having that $25,000 and being forced to sell investments in the depths of a crisis costs you $10,000 or $15,000 easily. Insurance is cheap. Disaster is expensive. The fourth critical action is what I call aggressive cycle refinancing. You will monitor interest rates obsessively and constructively, refinance your debt every time you manage to reduce the rate by at least half a percentage point. Most people refinance when the difference is 2 or 3 points, because that's what the bank suggests is worth it. That's lazy advice. The actual math is different. If you have $200,000 in a mortgage at 4% and you can refinance it to 3.5%, you save $1,000 a year. If the cost of refinancing is $3,000, you recoup the cost in 3 years. If you plan to stay in the house for more than 3 years, it's positive math. But here's where it gets interesting. Every time you refinance and reduce your cost of equity, you increase the spread between your investment return and cost of debt. If before you had a 5% spread, and now you have 5.5%, on a $200,000 portfolio, that's an extra $1,000 a year going into your net worth. Forever. $1,000 a year over 20 years at 8% compound return turns into $48,000. You paid $3,000 to create $48,000. Return of 1,600% on the decision to refinance. And the more times you do this throughout the interest cycle, the more you accumulate. Between 2010 and 2021, there were at least 4 windows where refinancing made mathematical sense. Those who took all 4 reduced their effective rate from 5% to 2.75% over the decade. On a $300,000 mortgage, that's $6,750 a year in savings. Over 10 years, that's $67,500 kept in your pocket instead of going to the bank. But you need to be aggressive. Don't wait for the bank to call you with an offer. You monitor rates monthly, have alerts configured, and when you see an opportunity, you act in days, not weeks. The process takes 30 to 60 days, but the decision needs to be made within 48 hours because rates move. In 2020, there was a 6-week window where rates fell to historic lows. Whoever acted got 30 years at 2.75%. Those who hesitated lost. Rates rose back to 3.25% in less than 2 months. Half a point difference doesn't seem like much, but on $300,000 over 30 years, that's a $47,000 difference in interest paid. $47,000 decided upon in 6 weeks of hesitation. And here's the refinancing that most people don't consider. Refinancing for a longer term, even if the rate is slightly higher. If you have 15 years left on the mortgage at 3% and can refinance for 30 years at 3.25%, mathematically it might make sense. You slightly increase your interest cost, but drastically reduce your required monthly payment, giving you more cash flow flexibility. You can continue paying the previous amount voluntarily if you wish, but you now have the option to reduce payment if you need liquidity. Flexibility has value, especially during crises. This strategy saved us at Bridgewater in 1990, when we extended terms on some credit lines, even with a small rate increase, and it gave us the flexibility we needed when the market became turbulent in 1994. The 5th action you need to implement immediately is rate hedging. This will sound technical, but it's simpler than it sounds and can save you from destruction when rates rise unexpectedly. It works like this. If you have a mortgage or line of credit with a floating rate based on the base rate plus margin, you are exposed to the risk of the rate rising and destroying your math. Imagine you have $200,000 borrowed at base rate plus 2%. Today the base rate is 3%, so you pay 5% in total. Your investment return is 9%, positive spread of 4%. Everything is perfect. But if the Fed raises the key rate to 6% in 18 months, suddenly you're paying 8% on the debt. Your positive spread has turned negative. You are losing money. The debt strategy that was constructive turned destructive. How do you protect yourself? Either you fix the rate by refinancing to a fixed rate, paying a small premium but eliminating the risk, or you use financial instruments that rise when rates rise to offset the increase in your cost. For most people, the practical solution is to keep a maximum of 30% of constructive debt at a floating rate and 70% at a fixed rate. This way, if rates explode, only 30% of your debt becomes expensive, the other 70% remains at the original cost. In 2004 and 2005, one of the most expensive mistakes I saw was people refinancing from fixed rate to floating rate to save half or a percentage point when floating rates were low. It seemed smart. They saved $2,000 a year. But when the Fed started aggressively raising rates from 2004 to 2006, those floating rates went from 4 to 7.5%. People who had saved $2,000 a year in 2004 and 2005 ended up paying $6,000 more a year from 2006 to 2008. Net loss of over $10,000 because they were greedy with half a point of temporary savings. The lesson is clear. Protect yourself against rate moves that destroy your arbitrage. The rule of thumb I've used for 40 years is that if the difference between fixed and floating rates is less than 1 percentage point, always choose fixed. You pay a small premium for predictability and protection. If the difference is greater than 1.5 percentage points, you can consider floating, but monitor like a hawk and refinance to fixed as soon as the spread narrows. Never, ever be exposed to floating rates on more than 30% of your total debt. The risk of destruction is asymmetric. You save little when you get it right, but lose everything when you get it wrong. The sixth action is to create what I call an explicit arbitrage portfolio. And this completely changes how you view your investments. Instead of having a generic investment portfolio, you will divide your assets into two completely separate mental accounts. Account 1. Resilience investments. That's money you'll never touch, no matter what. It's long-term retirement, children's education, goals for 10 or 20 years from now. That money goes into low-cost passive strategy, buy and hold globally diversified indexes, rebalance annually. Forget about it. You don't move here when the market falls. You don't move when it rises. It is the base of your wealth pyramid. Account 2. Arbitrage capital. This is money that exists specifically because you held cheap constructive debt throughout. You have to pay it. The difference between what you owe and what you would be zero if you had paid it all. This capital has a specific mission: to generate a return greater than the cost of the debt that financed it. You're going to be more active, more tactical here. You will look for asymmetric opportunities, individual stocks of solid companies in liquidation, REITs with high yield, corporate bonds when spreads explode. This money can and should take on more risk because you have a shorter time horizon and a specific objective of surpassing a reference rate that is the cost of your debt. Here's why this matters psychologically. When you separate it explicitly, you understand that if arbitrage capital has a bad year, you didn't fail on the life strategy, you had a bad year on a tactical part of the portfolio. You don't panic and undo everything. But when you mix it up and don't mentally separate it, a bad year seems to validate that you were wrong to hold debt, and you make destructive emotional decisions. At Bridgewater, we always separate client capital into mandates with different objectives. All weather was for resilience, pure alpha was for absolute return. The client knew what to expect from each person and didn't get confused. You need to do the same. If you have $300,000 in investments and $200,000 in constructive debt that you could have paid off, you mentally separate. $200,000 are resilience investments, $100,000 are arbitrage capital. The $200,000 you manage as you would anyway, passive and diversified. The $100,000 you actively manage to overcome the 3 or 4% that the $200,000 debt costs you. If the $100,000 yields 10%, you have generated $6,000 to $7,000 of positive spread. Even if they yield 6% in a bad year, you still generated $2,000 to $3,000 in positive spread. Only if you yield less than the cost of the debt do you have a problem. And this is rare over time. And here's the hidden benefit of this structure. You become a better investor. Why? Because now you have real skin in the game. When you invest money that is genuinely yours, without debt, you can be lazy, leave it in any fund, not pay attention. But when you're investing while carrying debt, you know there's a minimum fee you need to overcome. It forces you to be more intentional, learn more, make better choices. It's the difference between betting with house money and betting with borrowed money. The second makes you think twice about every decision, and that's a good thing. The seventh and final critical action, and this is the most psychologically difficult, is what I call the strategic poverty vow. It sounds contradictory, but it is the difference between theory and practice. You will make a commitment to live below your means during the first 5 to 7 years of implementing this strategy, not at the level of what you earned, but at the level of 80% of what you earned. Why? Because you need a margin of safety while building the system. If you earn $6,000 a month and spend $5,800, you have a margin of $200. Any fluctuation breaks you. But if you commit to living on $4,800, you have a $1,200 margin. This $1,200 goes partly to build the firewall, partly to arbitrage capital, partly to absorb variation in expenses without blowing up the budget. For 5 years, $1,200 a month is $72,000. $72,000 of margin of safety being built as you implement constructive debt and arbitrage portfolio. Without this margin, the system collapses at the first turbulence. I've seen this in my own life. When I started Bridgewater in 1975, I lived in a 2-bedroom apartment, drove a used car, ate at home 90% of the time. I earned a reasonable amount, but lived as if I earned half, because I knew I was building something and needed buffering. When the market boomed in 1982 and income dropped 80%, I had 3 years of expenses saved. I survived, I adjusted, and when the market came back in 1983, I was positioned to grow aggressively. If I had lived on the edge, I would have gone bankrupt in 1982 and Bridgewater wouldn't exist. And here's the brutal truth. Most people can't live below their means. They earn more and spend proportionally more. They earn $4,000, spend $4,000. They earn $8,000, spend $8,000. There is never any margin. This destroys any wealth-building strategy because you never have the time to make mistakes. You never have the capital to opportunity. You never have the peace to think strategically. You are always reacting, always on edge, always one problem away from disaster. The strategic poverty vote breaks this padron. You consciously choose to temporarily live below your means to permanently create the life you want. And temporary here means 5 to 7 years. It's not forever. It's a construction sprint. Once you have the firewall, arbitrage capital working, debt managed, you can relax. But in the first few years, it's total discipline. Without it, you're just playing around with pretty concepts, but not actually implementing anything. Now, I know exactly what's going through your head because I've heard these objections 1,000 times over the last 45 years. The first is, but Ray, I feel uncomfortable having debt, even though the numbers say it's better. Psychologically, I can't sleep knowing I owe money. Let me validate that for a second. I completely understand. We have been culturally programmed to associate debt with moral failure. Your grandfather told you that debt is shame. Your religion may have taught that a debtor is a servant of the creditor. I deeply respect these values. But here's the problem with letting emotion guide financial decisions. Emotion can't do math. Your psychological discomfort with owing $200,000 at 3% doesn't change the mathematical fact that you would be $300,000 richer in 20 years by holding that debt and investing. Your peace of mind today costs $300,000 tomorrow. If it's worth it to you, perfect. It's your choice. But you need to make this choice consciously, knowing the exact price, not based on a vague feeling that debt is bad. And here's what I learned. Once you do the math once and see the money actually growing faster with the management strategy, the emotional discomfort goes away. You stop feeling debt as a burden and start seeing it as a tool. Anxiety was based on not understanding, and understanding dissolves it. Test for 1 year. Take the monthly arbitrage test I described. When you see the positive spread generating $3,000, $4,000, $5,000 of extra equity in 12 months, your mind will recalibrate. The second objection I always hear is, what if the market drops 30%? Then I'll have debt and investments worth less. The worst of both worlds. Okay, let's do the math on this catastrophic scenario. You have $200,000 in investments and $200,000 in debt. Market drops 30%. Your investments are now worth $140,000. Your debt remains at $200,000 because debt does not fluctuate with the market. Net worth is negative at $60,000. It sounds terrible, and it is. But now, let's compare it with the alternative scenario where you had paid off the entire debt. You had 0 investments and 0 debt. Market drops 30%. You continue with 0. No gain, no loss. But, and this is crucial, you also don't have the capital to buy the liquidation market. When the market recovers and rises 50% from the bottom, which always happens historically, you are still at 0. The person who had investments and debt, his $140,000 turned into $210,000 when the market recovered. Minus the $200,000 in debt, she has $10,000 in positive net worth. Most importantly, she participated in the recovery. Over 5 years after the crisis, when the market returns to where it was and then rises another 20%, she has $270,000 in investments minus $200,000 in debt equal to $70,000 in equity. You, who paid everything, continues with 0. The difference is $70,000 created by having weathered the volatility with strategic debt, and that assumes she didn't do anything smart during the crisis, like buying more when everything was on sale, which would have multiplied the gain even more. The fear of temporary drawdown makes you miss out on permanent gains. The third objection is the most dangerous. I'll start this when I'm better off, when I have more saved, when I'm done paying for some things. This is the objection of procrastination disguised as prudence. Here's the cruel reality. If you wait to be in a perfect situation, you'll never start, because a perfect situation does not exist. There will always be some unexpected expense, some uncertainty, some excuse to postpone. And while you put it off, the years pass. 5 years of waiting for the perfect situation is 5 years of compound interest that you lost forever. If you start today with what you have, imperfect, clumsy, but start, in 5 years, you are 5 years ahead. If you wait 5 years to get perfect, in 5 years, you are at zero. And here is the data that destroys this objection. In 2009, at the time of the crisis, those who started investing at that time, even maintaining mortgage debt that was underwater, even with unstable employment, multiplied their assets by 3 in the following 10 years. Those who waited for the situation to improve waited until 2013 or 2014. He took half of the winnings. A perfect situation is the enemy of an imperfect start today. History proves time and time again that imperfect today trumps perfect tomorrow. If you've made it this far and are still with me, you're seeing something that 98% of people refuse to see. The signs are all flashing. You have expensive debt that is silently destroying you and cheap debt that could be working in your favor, but you